I'm a little worried about us as a society.
Probably with good reason. Yeah.
I'm not really sure what to do about this, but I was in Home Depot over the weekend and I saw something that just kind of scared me a little bit. It was near the kitchen,
Were they
near
tools?
kitchen tiles, actually.
Okay.
I saw Christmas decorations in September.
My son was wondering why he asked that same question. And we started talking all about markets or commercialism. Is that the thought that came to your head?
Well, I mean, I don't have children yet. I was more so just, I wanted to make sure that I saw what I saw. And I went to the Home Depot tent. I said, hey, I'm not really sure what to do about this. The foliage hasn't fallen yet. It's still just the beginning of fall. But I will say, that's typically my signal to do end of year financial planning. So I don't know if that's,
Yay!
yeah, I don't know if
That
that's
makes me
more.
happy. I like it.
Yeah, I think that's like more on me. But there's a lot typically we got to clean up with our plans towards the end of the year, tax strategies we got to consider before all the see you next year jokes roll out at the end of December for the new year. So my name is Michael MacKelvie. I'm a certified financial planner with Mariner Wealth Advisors. Valerie Escobar is also joining us here. She's a certified financial planner with Mariner Wealth Advisors. This is Your Life Simplified. If you're new here, make sure to subscribe, whatever channel you're listening to, YouTube, Spotify, Apple Podcasts. Valerie, we got a checklist to go through to help people out with what they should do end of year here.
Oh, we sure do. And I love saving on taxes. I love telling people how to do it because I haven't met anyone that's really jazzed about paying a lot in taxes. And so this checklist is super handy. It's better than Christmas decorations. So number one, very important that you max out your retirement plans if you have that the ability. This one I think just doesn't get as much celebration as it should because it's kind of boring, but put all the money you can into that 401k, whatever it is that you have through work, because that's really going to be the source of saving you the biggest amount on money on taxes that's out there probably.
Yeah. And I think with that too, like sometimes, I don't know if you've seen this, but people are like, oh, well, I'm at like 12,000 for the year. It's like, hey, you could defer technically your entire salary if you wanted to. Right. To if you maybe have enough in cash, you could just say, hey, I'm just not going to take a paycheck these next couple of weeks. So
Yep. And that's a great point. I mean, when you do your 401k, you can't do like a huge lump sum all at once. That's much more than your paycheck. So you got to balance it out. But yeah, I mean, if you can afford it cash flow wise, then definitely do that.
I've seen it.
Yeah. And so another thing too, with, we're talking about cash flow. So the next thing that we want to talk about is backdoor Roth IRA contributions. And so for this one, what you want to do is you put money into an IRA, and this is it can get messy, but basically you put money into an IRA that you don't currently have at all, and it's all non-deductible. Which means that you probably make too much money to be able to contribute to an IRA and make it deductible. So you put it all in there and then you turn it around and you convert it into a Roth IRA. And this is something that, depending on your CPA, some CPAs like to do it at the beginning of the year. You make the IRA contribution and then you do the conversion at the end of the year. Some don't care. This is sort of a loophole that, we're waiting for the IRS to pick up on and do something about. But while it's there, go ahead and use it. And I think that's a really good use of money. Mm-hmm.
Yeah. I mean, just any Roth conversions in general, right? I think at the end of the year, you might have just opportunities to convert monies. You might have that backdoor Roth IRA opportunity. And again, just making sure you're aware of all the opportunities to max out accounts. I think that's something you definitely want to check up on before, hopefully, again, those see you next year jokes at the end of December. Also, if you're 72 and over, making sure you're doing your RMDs. So making sure you're taking anything out. If you don't, it's a 50% penalty. You probably don't want that. For QCDs as well. And then beneficiary designations. Our loves our love lives tend to change. You might have a new beneficiary in mind. You might need to switch it up because there's a new grandchild, there's a new child, there's a new
Yep.
spouse. And I've seen all of those. Somebody passed away. So making sure that you check your beneficiary designations on all your accounts, I think is something to remember as well.
For sure. And then there's kind of the opposite, spouses that go away and that we don't want to have as our beneficiary anymore. That's always important to make sure that we're getting um, removing if we're wanting to go that way. And just a quick note, really quick on the RMDs. Require minimum distributions. That's what that stands for. In case anybody out
Yeah.
there is not up with all of our jargon and
Thank you.
lingo here, and making sure this is something I recently ran into, that was a mistake made by a prior advisor of a client that came on. That if you have your IRA and then you also have like an old 403b or a 401k, each of those plans, they have their own required minimum distribution. So you can't just take it all from the IRA for the whole shebang and think that it's all taken care of. Those are separate.
Right.
And then remember, if you are charitably inclined and you want to use that RMD amount to do a charitable contribution,
Great
that's what this
opportunity.
QCD, qualified charitable distribution, and then you just make the RMD amount directly to whoever, and it's got to be a a charitable organization that has very specific qualifications, but it's totally tax free. So
Yeah.
something else to do. Again, 12/31 deadline. So that's really what we're focused on today.
Keep that in mind. Yeah. And then HSAs, right? We
Yes.
want to make sure that we're contributing to our HSA if there's that opportunity. Triple tax savings here, Valerie. I mean,
What
it
does
doesn't get
that
any better
mean?
than that. It doesn't get any better than that. Tax deduction going in,
Hmm.
tax-free growth, and tax-free distribution for qualified health events. You're probably going to have some qualified health event at some point in your life. It might occur at 80, might occur
Hmm.
in the next year. But again, there's huge benefits there. And one of the things people don't realize with HSAs, I was just having this conversation actually with my girlfriend last night, you can invest them. I mean, so many
Hmm.
people don't know that. They just assume it's this account, you put money into it. You can invest your HSA in a lot of ways. It's treated like an investment account. So big opportunity there. If you have an HSA to maybe max it out, or if you're getting to open enrollment, consider it with that high deductible plan. If you maybe don't have, major health considerations and you're going to the doctor a lot, right?
Yeah, yeah. And one of the things that's so great about an HSA, a health savings account, is that those are not use it or lose it, right? You keep putting in money every year and it grows and grows. If you have a flex savings account, an FSA, that is use it or lose it. And so maybe that's another thing that we, don't leave money on the table.
Distinguish. Great point.
Yes, 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 and make sure that you spend out that stuff. And some I've seen people that I've been needing to get my knee fixed, and I just don't feel like it. And well, I have money there, so I'm going to go spend the money on whatever it is.
Right. Right.
Let's see. Next on our checklist, let's move into gifting. We talked a little bit about doing those qualified charitable
Season of
distributions.
gifting.
That's right. That's right. See, now we're back to Christmas. Oh, I love that. The real reason, it's for giving, not receiving. So each year, let's see. Currently, we're at $16,000 per donee that you can give $16,000. So you can give. Who's your favorite person that you're going to be giving to, Mike?
My mother.
Me. Oh, your mother. Okay, and then me.
No, I
Um,
have an organization actually that I look to for this primarily, but keep going.
Okay.
Sorry.
Okay. Well, that doesn't count. We're going to go with your mother.
All right.
So let's
Fair
say you're
enough.
giving to a person, first of all, right? So you want to give her 16,000, you can do that. And it's not like the IRS is going to say, I don't care, do that. And then let's say Samantha also really likes your mom, or she's trying to get her good graces. She can also give another 16,000 to your mom.
I'll let her know that.
Yeah, yeah. That's right. So to all your friends, you have a lot of cash to give away. So make sure that you're doing that by the end of the year. And you can use this for making your 529 contributions as well. So if you've got a kid in your life, a grandkid, somebody, you can make those big contributions towards that.
That's a big
One
point.
thing that I've seen before too is that, let's say that you have a big investment, right? I bought a bunch of, I don't know what's I can't even think of what stocks have risen hugely in value. But let's pretend there is one that exists nowadays, and the cost basis is super low. I bought it at $100, and now it's worth $300 a share, and I want to gift this to somebody else.
Mhm.
That cost basis does move to the recipient. And so now, if I gave my $16,000 to your mom, but all of stock with low cost basis, when she goes to sell it, she's going to be responsible for all those capital gains. And so,
Right.
you know, there's a little bit of a caveat that went along with that gift, but I'm trying.
Yeah. And that's where it can be, wise to look at low basis stock
Yes.
or low basis investments when you're considering gifting, getting rid of that tax liability. Essentially, you can give more through looking at maybe low basis
Yeah.
investments. And I think that's where, when we're talking with a lot of folks, and we're evaluating which vehicle is maybe right for them, whether it's donor advised funds, if they're considering foundation work, a private foundation, or a charitable trust, whatever it might be. We do typically look at where their taxable holdings are. And I know
Mhm.
you look quite deeply into donor advised funds. I know you're a fan of those, right?
Yeah, and I love any solution that in general, the simpler it is, the better. And donor advised funds are super easy because it's basically an account that you open somewhere. Fidelity, for example, has one that we use quite a lot. You put money into that donor advised fund. And then once the money's in there, you can sell it, you can trade it, you can do whatever you want, and then let it just sit there forever until you're ready to actually give it to somebody. So it
Right.
helps to for people that haven't made a decision, which charity do I want to give to, and I think we're gonna, maybe you'll talk about this later about bunching deductible or itemized things that we want to put on our returns. You can put all of your, I have a 5-year plan to give $10,000 a year. Well, I'm going to just give all 50,000 all at once. But yeah, donor
Yeah.
advised funds are just a really turnkey, easy way to give money. And like you said, with that with stocks that have a low cost basis. If it's worth 100,000, but your cost basis is only 10,000, that $90,000 of growth is inside of that donor advised fund, and they don't have to pay the taxes at all because it's a charity
That's the
effectively.
benefit. You can give
Hmm.
more, right?
Right.
Your dollar goes a little bit further. So definitely something to consider. I would say on the topic of gift taxes and gifting, understanding that we are in the highest federal gift tax exclusion environment. I'm sure this is something we're always thinking about of all time. Okay, it is astronomically high compared to where it was, even adjusted for inflation. So uh, it's nearing $12 million per person federally, right? And
Hmm.
what that means is you have the ability to really get a lot of money out of your estate in a tax efficient way. So, um, one of the things that's certainly on the chopping block for Congress, depending on what political party we have there and what the majority is lowering that gift tax exclusion. And if that happens, essentially, I'll just boil this down as best I can. What that means is you will be able to give less, right? You maybe,
Hmm.
if you cross that threshold, you just can't give as much because more of it would need to go to taxes. And we're speaking if you're giving it to, personal family members, it's not a charity, right?
Right. Right.
So important distinguishing point there. But again, I would just keep in mind, it is difficult for me to fathom that if we do decide to raise revenue at some point in time, we do it by raising taxes, and that isn't one of the first things that everybody looks at because it's only affecting less than 1% of the population, and typically it's very easy to say, okay, let's change that. It's only benefiting a small minority of people from a tax code standpoint, so just keep that in mind.
Right. Yeah, and that's a great point. I think a lot of, people will hear, "Oh my gosh, they're making a change that will increase taxation on $5 million per person." Well, the vast majority of us don't have that extra $5 million in assets to worry about anyways. So, yeah, I
Right.
I see that being on the chopping block for sure, just
But I
because
mean,
it's
if you
such an
look
easy
real
thing.
quick on that, if you look to like the previous estate tax threshold, I mean, I think,
Mm.
it was less than a million, if I remember right. And I'm not talking like about, 1940s, but, they like within the last few decades, it was around a million. And so that would capture, I mean, can you imagine if they changed that from, nearly 12 million to, let's just say, 2 million? I mean,
Right.
that's a big difference. So it could
Hmm.
capture a much larger audience. I don't think they'll drop it that drastically, but something to keep in mind,
Right.
right?
Yeah. No, absolutely. Again, something to be touching every year for sure.
Yeah.
Let's see. I think so. Charities. We were talking about all of that. Let's go to taxable accounts. For this last one, so we're not IRAs, right? We're talking about just brokerage accounts that you have to pay capital gains tax every year if you have a taxable capital gains event. And so one of those things is just looking at tax loss harvesting. And we've talked about this in other episodes. It can get kind of hairy, but effectively, if you have some positions with big gains, some positions with losses, you could sell some of those positions with losses and harvest that loss to offset any gains that you have. And so
Yep.
maybe you want to realize or sell some of your stocks that have a really high concentration. Or another idea too is that if you are in a low tax year, like let's say you took a gap year or retired early or something, and you have those highly concentrated stocks with a low cost basis, go ahead and sell some because there is a 0% cap or 0% long-term capital gains tax rate if you make less than, I think, about 80,000 for
Married.
joint married couples.
Yeah.
Yeah. Yeah. So I think that that's
Yeah.
something to take a look at.
And check out our tax loss harvesting video if you haven't seen that. We dive into
There you
that
go.
a little more
Yes.
deeply. Self plug, nothing wrong with that. So again, there might be opportunities, what you're saying, to, really at the end of the year with a taxable account, especially in a year where most things are down, take
Hmm.
advantage of some of these losses and maybe offset some pre-existing gains that you've had for several years. So something to
Hmm.
definitely take a look at. I would be strategic with that. People sometimes just, again, chase tax savings in lieu of the fundamentals. So
Yeah, sound
I would consult a
investing is
professional on that
still
one.
very important for sure.
Yeah.
And I guess I forgot to mention too, if you do end up, you have just losses or whatever, $3,000 of that can be used to offset your ordinary income. And so it's not a
Yeah.
huge number, but it's
That's still
$3,000
something,
less.
right?
It's still
Yeah.
something.
I
Yeah.
mean, if you're in the, if you're nearing the top bracket, that might be $1,500. It's easy, right?
Yeah. There you
So
go.
maybe
Yeah.
something. Um, if you do own a mutual fund, one of the things to maybe check is the capital gains distributions. So I feel like it's pretty rare now that people have, it's still out there, but it's more rare that people have mutual funds in a taxable account. I feel like the awareness of the consumer has certainly risen here as far as tax efficiency. And mutual funds maybe don't always have the most tax efficiency, but
Hmm.
maybe you have, let's say, a real estate investment trust that's wrapped up in a mutual fund, or some other type of mutual fund that's going to distribute a capital gains distribution. Check and see what that is,
Hmm.
because again, you don't want to be hit with that and then 3-4 months later say, oh geez, I owe an extra 1,000-1,500 bucks from this mutual fund that I have. So maybe even reconsider what you're holding in that taxable account if it is kicking off a lot of taxes.
Yeah.
Maybe that's a nudge to do that, right?
Right. No, absolutely. Consider your asset location. And I mean, if you bought the fund because you like the distributions, then keep it, but be aware that it pays
Yeah.
taxes. And
That,
so,
that is funny. Sometimes people will just, they're like, hey, I like the dividend that it pays off. And it's like people forget that the dividend is paying if the company has income, right? If they have profits, essentially.
hmm.
So
Hmm.
while there might be income there and you really like that, that is not certainty. And again, part of that is to attract people. So
Yeah.
there's kind of an irrelevance of dividends in some ways that people kind of get pulled into there, and because of that, they maybe are paying more taxes in their taxable account. So yeah, great point. Hopefully you found this helpful. Hopefully you're a little worried again about us as a society if you did see Home Depot decorations as well. But if you're listening to this and you have not subscribed, make sure to subscribe on YouTube, Apple Podcasts, Spotify Podcasts, wherever you're listening, to get more industry insights from industry professionals here at Mariner Wealth Advisors. I'm Michael MacKelvie, CFP. I was joined again with Valerie Escobar, who's a CFP. You guys take care.
See you guys next time.
Mariner Wealth Advisors, or MWA, is an SEC-registered investment advisor with its principal place of business in the state of Kansas. Registration of an investment advisor does not imply a certain level of skill or training. MWA is in compliance with the current notice filing requirements imposed upon registered investment advisors by those states in which MWA maintains clients. MWA may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Any subsequent direct communication by MWA with a prospective client shall be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. For additional information about MWA, including fees and services, please contact MWA or refer to the Investment Advisor Public Disclosure website at www.advisorinfo.sec.gov. Please read the disclosure statement carefully before you invest or send money. The views expressed in this podcast is for educational purposes only and do not take into account any individual personal, financial, legal, or tax considerations. As such, the information contained herein is not intended to be personal, legal, investment, or tax advice. Nothing herein should be relied upon as such, and there is no guarantee that any claims made will come to pass. The opinions are based on information and sources of information deemed to be reliable, but Mariner Wealth Advisors does not warrant the accuracy of the information. Asset allocation diversification is a strategy designed to manage risk, but it cannot ensure a profit or protect against a loss in a declining market. Certified Financial Planner, trademark, CFP, registered trademark, and federally registered CFP with flame design marks, collectively the CFP registered marks, are professional certification marks granted in the United States by Certified Financial Planner Board of Standards, Inc., also CFP Board. The CFP registered trademark certification is a voluntary certification. No federal or state law or regulation requires financial planners to hold the CFP certification.